something crazy is happening in the markets right now. And it affects you even if you've never bought a single tech stock. If you have a 401k, if you invest in index funds, if you own an S&P 500 ETF, nearly half your money is already tied to AI, and you might not even know it. Welcome to ARC Digital, where we break down big financial stories in a way that actually makes sense. The concentration problem right now: about 40% of every dollar invested in the S&P 500 goes to just 10 companies. We're talking about giants like Nvidia, Microsoft, Apple, Alphabet, Amazon, and here's the wild part: Nvidia alone now represents roughly 8% of the entire S&P 500. That means for every $100 invested in the index, around $8 goes to Nvidia. That's massive concentration. The spending explosion: these AI giants are expected to spend over $330 billion this year on data centers, chips, and GPU farms. That's not small. That's historic-level capital spending to justify today's stock prices. Analysts estimate these companies would eventually need to generate around $2 trillion per year in profits. For perspective, that's more than Apple, Amazon, Microsoft, Google, Meta, and Nvidia combined today. That's not growth, that's perfection priced in. The $1.4 trillion question: even Sam Altman floated the idea of a $1.4 trillion global AI infrastructure plan. But here's the concern: OpenAI reportedly generates around $20 billion in revenue. When questioned about the gap between revenue and spending ambitions, the answer wasn't exactly detailed. At one point, it was even suggested that the US government might need to act as an insurer of last resort. And that's when investors started paying closer attention, because that sounds a lot like bailout language. The feedback loop: here's how the AI money loop works. Nvidia invests billions into OpenAI. OpenAI pays companies like Oracle and Microsoft for cloud services. Those companies buy more Nvidia GPUs, Nvidia profits, and reinvests. On paper, everyone looks like they're booming. But in reality, a lot of the money is circulating within the same ecosystem, sometimes financed with debt that doesn't always show up clearly on balance sheets. It's growth, feeding valuations. Section 5. Why this matters to everyone, you might be thinking. Okay, so what if tech investors lose money? Here's why it matters. AI stocks dominate the S&P 500. As their prices rise, index funds automatically allocate more money into them. That creates a powerful feedback loop. Rising prices gives more index buying, gives even higher prices, even if real profits aren't growing fast enough. And when markets become this concentrated, volatility increases. If AI slows down, the entire market feels it. The warning signs: some legendary investors are signaling caution. Warren Buffett is sitting on one of the largest cash piles in history. Michael Burry, who famously predicted the 2008 crash, has reportedly placed bearish bets against companies like Nvidia and Palantir. Different strategies, same underlying message. The market may be pricing in a future that hasn't arrived yet, and may not arrive as quickly as expected. The bigger picture, according to Deutsche Bank: if it weren't for AI-related capital spending, the US economy might already be flirting with recession. In other words, AI isn't just driving the stock market. It may be propping up economic growth itself. That's a lot of weight on one theme. Closing. So the real question isn't, how big will AI get? The real question is, How long can hype stay ahead of profits? And what happens when reality catches up? If you found this breakdown helpful, make sure to like, subscribe, and hit the notification bell. This is Arc Digital, where we cut through the noise and help you see what's really happening in the markets.